So we'll go ahead and get started. Make sure we're muted and all that. Great. All right. So we often use the word health insurance, right? But health insurance is a bit of a misdemeanor. What's wrong with me today? Misnomer, as if we're not actually health insurance, right? If you had health insurance, it would be a little drone over your shoulder, and it would zap you when you made bad decisions. That would be health insurance, right? You drive too fast, the drone would zap you. You smoke, the drone would zap you. You drink too much, the drone would zap you. It would just like constantly zap you from making bad health choices. And that's not actually what we have yet. I'd like to market that product. So if anyone wants to come in with me, health insurance, I'd love to actually have that, just like a little drone. And then anytime you make a bad health decision, like let's say you don't run in the morning, you get zapped. You want to eat a second cookie, zap. Anyone want to come on that with me? It would work though. Think about how healthy you'd be. And you'd be like, I'm tired of it. I can't do it anymore. It doesn't matter. You still get zapped. Just over and over again zapped. Well, it's my dream. It's my vision. But I want that one day. So what we mean when we say health insurance is medical expense insurance. So what we're actually doing is buying medical expense insurance, which protects us from bad things happening. It protects us when we have bills that we're not ready or prepared for. And so we really mean medical expense insurance when we say health insurance. So let's see. So we're going to talk a little bit about common characteristics of major medical expense insurance and some of the things that aren't here anymore and were here before. First off, that in today's world, there are very few exclusions and limitations. There are some things that medical insurance doesn't pay for. But for the most part, it's going to cover most health events that happen to you. If you're in a car accident, though, generally we try to reimburse the health insurance with your auto insurance, and so that's one way that we don't always have great coverage. Pre-existing conditions are something that disability insurance still has, long-term care insurance still has, but health insurance doesn't have. And I want to bring it up because pre-existing conditions are a topic of political banter. So a pre-existing condition would be something that's wrong with you or an event or a heart attack that maybe occurred. And in the past, health insurance companies would say, and this is back before the Healthcare Reform Act came into play, is all right, well, if you had a heart attack, then we're going to wait 5 years before we insure health costs around that heart attack again. So on the one hand, the health insurance company doesn't have to insure your heart, and it's cheaper. But on the other hand, most likely if you have more expenses, it'll be another heart attack, and that's going to be very expensive for you. So pre-existing conditions are one of those things that we kind of see both sides of economically, right? If you don't allow any pre-existing conditions, if you have to insure everybody, then health insurance is more expensive. If you allow some pre-existing conditions, maybe it's cheaper, right? So politically, that's a conversation that we have over and over again, and that's what a pre-existing condition is, and it's something that y'all won't have to worry about going out into your careers, but in disability and in long-term care, you still might. Right? Those are areas where we still do allow pre-existing conditions. Insurance companies have deductibles. Deductible is the amount you have to pay before insurance kicks in. So a deductible on a plan, and a group plan, may be relatively low, right? You might have somewhere in the neighborhood. What's the U of I plan deductible? Do you know offhand?
No, I don't know, like 500.
500 or 1,000, relatively low deductible. If you have private insurance on your own, as Colin and I went to a farm income seminar, the deductibles today are somewhere in the neighborhood of 7, 8, 9, 10 grand before health insurance even pays a penny, right? So in the independent market, one of the ways that costs are being controlled is very high deductible plans. So that's the amount you have to pay in before your insurance company does anything, right? And so the deductible on a plan really needs to match up with your emergency fund from the standpoint of choosing coverage if you have that luxury. Co-insurance is the amount you've got to pay out of pocket after you hit the deductible, all right? So the first dollars in are yours. You got to pay that deductible. Once you hit that deductible, then co-insurance applies. So co-insurance is the percentage of costs that you have to pay for as an insured, right? And co-insurance is going to vary. If you go to a doctor that is in that insurance network, you might have one co-insurance percentage, let's say 25%. If you go to a doctor outside that insurance network, it may be much higher, 50%, right? So co-insurance then continues after the deductible's met. So another way we can control cost in the health insurance world is by raising that coinsurance percentage. For maybe it used to be 10%, 30 years ago. Now you're looking at 25 to 50% of costs. You do that until you hit a family maximum benefit. That's the internal limit bullet there in the slide. So a family maximum benefit usually kicks in the plans I'm familiar with, somewhere around $10,000 to $20,000 when you've paid that out of pocket, right? So you pay, what's the first thing you pay in a plan? You pay your deductible, and after that you start paying up to a family maximum limit. Those internal limits are stated in plans, usually somewhere in the $10,000 to $20,000 range. There's an internal limit, and at that point, the health plan pays 100% as long as you use their in-network doctors. All right. One other element of healthcare plans that you're going to walk into today is the idea of unlimited benefits. That if you have an expensive brain cancer, that health insurance plan will go ahead and pay those costs without looking at a limit. My mother had breast cancer in 2005 to 2008, and in that 3 years, she racked up almost $1 million of costs. Okay. Right now, the way health insurance works is that you really have an unlimited benefit. That didn't always used to be the case. 10 years ago, health insurance plans had caps, $1 million or $2 million, and that was it. Then they just quit paying. So can you imagine that kind of world where you got diagnosed, your kid got diagnosed with cancer, and next thing you know, you're at the limit? That's rough. So unlimited benefits is another issue that's risen, kind of driven up healthcare costs for consumers, right? On the one hand, we have unlimited benefits. On the other hand, health insurance premiums are at an all-time high. So where do you find the balance there? It's something to think about in our conversations. So that's one other issue. The last thing to talk about is this concept of reasonable and customary charges. An insurance company is going to set reasonable and customary charges, and based on where you live in the world, you live in San Francisco, you live in DC, you live in New York, those hospitals may charge more for services than Cigna or Blue Cross Blue Shield believe are reasonable. And then you get stuck in a weird world of arbitration. A very recent case was a school teacher in Austin, Texas, who had 3 stents put in his heart, and the hospital billed somewhere around $500,000 for that, and the insurance company was willing to pay somewhere around $100,000 for that, and he got stuck with the $400,000. So there was a GoFundMe to help this teacher out. I don't know if they'd hit the $400,000, but that's another issue in health insurance we're looking at right now, and y'all are looking at too, is cost. That's going to be something that you have to think about when you get care. Which sometimes when you have an emergency, you don't have the luxury of thinking about it, but that's another issue there. Is what's reasonable and necessary to Blue Cross Blue Shield, what's reasonable and necessary to a high-end hospital in the suburbs of Chicago? Could be a gap, and you're going to get stuck with that. So those are some big issues with insurance today. And I want to open up with those and kind of get into group plans and individual plans. But the conversation government is having today, and Congress and our executive, and we go back and forth with Republicans and Democrats, is that health insurance is very, very expensive. And the Health Reform Act made it more expensive. So now what? Right? Is it sustainable? And I think that's something you all need to consider as financial planners. When you work with retirees and older folks, such a huge cost of their retirement is health insurance. And these are the big underlying social issues why it's so expensive, right? So I want you to think about that as you go into practice and as you go into planning, okay? All right, so deductibles in major medical insurance. Deductibles, we usually have an individual deductible and then a family deductible. An individual deductible applies to me, right? If I'm injured, or I'm sick, how much do I have to pay out of my pocket? It would apply to my kiddos. Lily would have one, Ellie would have one. But there is what's called a family deductible, and that family deductible is, all right, we recognize that your total family costs, usually it's 2 to 3 times an individual cost. Once you hit the family deductible, the individual deductibles cease. So if we wind up, I get really sick, one of the kids gets really sick, we hit 2 deductibles, usually that's it, we're fine. Cover everybody else in the family for that period. So a common accident provision too, generally kicks in a policy and says, all right, you were all in a car accident together, one deductible's fine, and then move on. All right, so most policies have that. Okay. Talked about co-insurance, and this is a huge in-network, out-network deal in private and group insurance. With co-insurance, you know, usually you got to pay somewhere around 20% comes out of your pocket, and then 80% comes from the healthcare provider. When you have an out-of-network doctor, those get really skewed the other way. So most plans will say, as long as they're in network, it's 80-20. But you go out of network, you might even look at 50-50. Another issue is if the larger the co-insurance you've had a pocket, the cheaper your premium is. So you also need to weigh that in your coverage. Now, group plans, you're not really going to get any choices. But if any of you go into individual financial advising, or you have a client that retires before 65, why is 65 a magic age from the last class, pop quiz? What do you get at 65? What if you retire and take a Social Security at 62? When does Medicare start?
65.
There you go. Jack with the win. Thank you. 65, right? And that stop loss is the amount at which point your co-insurance, you get to quit paying your co-insurance. And that's your stop loss limit, right? And we talked about that a little earlier, 10 to 20 grand. Somewhere in there is the stop loss limit. Okay. Now, traditional plans, and we talk about managed care. Managed care provisions is the idea of having some kind of HMO or PPO setting where the insurance company controls costs and tries to make efficient care. So we call those managed care plans, right? HMOs, PPOs are type of managed care. Managed care relies on the insurance company controlling costs for it to work. Right? A health maintenance organization, an HMO, preferred provider organization, PPO, both of those rely on controlling costs. So they only get into agreements with doctors who are willing to agree to those control costs. Pre-admission certification for non-emergency surgery is one of the ways to have those costs. So I hurt myself last year moving, and my shoulder wound up freezing. I couldn't put my arm over my head. Because I'm a guy, I didn't go to the doctor, right? Because I'm a winner. It got worse and worse and worse. And it got to the point where surgery was one of the options. I went with physical therapy, but surgery was an option. And then the healthcare plan said, all right, you need to get pre-admission certification. We need to know why, what the surgery would be, what the costs are, how long would it take, and we have to prove it before you schedule it or we won't pay for it. Right, so pre-admission is a way a managed care plan like an HMO or a PPO helps control the costs. They say, well, is this really important? Is it necessary? Welcome. You've got two arms. Do you really need both? Right? Like, can you just use your left arm forever? I mean, your right arm really, what's it for anyway? Like, you carry the baby with your left, right? Why would you need the right? So, anyway, point being, pre-admission certification. Second surgical opinions, a managed care plan can force that. They can say, all right, we actually don't like that cost. Please go get a second opinion. And managed care tends to allow payments to non-hospitals. Hospitals are expensive. A night in a hospital at the low end is going to cost you $400, $500, $600, and that's assuming no one comes and checks on you. So hospitals are expensive. So managed care plans like things that aren't hospitals. So they're going to pay for things like home health care. It's cheaper to have someone come to you than you go to an emergency room. They're going to pay for things like birthing centers. So if you have a healthy pregnancy and want to work with a midwife, a birthing center may be the option. Save some money there. Hospice care, which would be in your last 6 months or so of life. If you're terminally ill, there's hospice facilities, and you can have hospice care in the home. So these are all options for not emergency room costs. All right. So that's the idea. Also, preventative care. Most HMO, PPO plans, you don't have to pay for a flu shot. Okay, and why not? Why would Aetna say, Craig, free flu shot?
Because they don't want you coming in multiple times with the flu.
Because they don't want me going to the emergency room with the flu, right? They don't want me feeling sick and going in and incurring thousands of dollars of cost when they can just pay. Imagine the Aetna rate of a flu shot. They probably get those for about $6. You know, that's going to be the managed care, right? So they don't really want you keeping coming in. Okay. Extended care facility like skilled nursing, again, not quite the level of a hospital. And home health care, managed care plans like home health care. All right, and you want to know that particularly for our quiz on Sunday, but they like it because it's cheap. And having someone come to you beats you going to the emergency room. Right? Kind of keep that in your mind. Like, how can Aetna save some money? That's how they would do that. Hospice can be in-house or in a facility for hospice care. So, terminally ill person. And the idea is where you kind of provide counseling and therapy and those kind of things. Again, birthing centers, if you have a healthy pregnancy, there used to be a birthing center right by our house in Bryn Mawr, and the birthing center would always have these big flags, like it's a boy, it's a girl. And one day they had, like, no joke, like 4 flags out the window. And we were like, whoa, that's a busy day for the birthing center, or triplets. All right, so managed care plans, your HMO and your PPO plans, okay? Health Maintenance Organization, preferred provider, that's the managed care. Most group insurance today is going to be managed care option, some union insurance aside. Most of us have managed care. That's what, when we go to an employer, that's what they pick. They're going to gatekeep the provider. If you don't agree to their terms, you can't sign up with them, okay? So only certain doctors are going to be on your plan list. Certain hospitals are going to be on the plan list. Certain care facilities and urgent care clinics are on the plan list. And if you go somewhere else, then you have to pay more, either out of pocket completely or that higher co-insurance provision. So just be aware of that with controlled access. That's the one downside here. We try to look at the comprehensive case, both to cure the person and keep costs down. So we want to have files on that individual and take a look at, okay, their health. As much as we can, preventative care. So I got an email from the Y that most health insurance companies in town, including the U of I health providers, will give you a discount on your YMCA membership. So that's pretty cool, right? Now, why are they going to do that? Okay, so why does Aetna, who I think is a provider, or Cigna, I forget which one, why are they willing to give me 10 or 20 bucks a month towards my YMCA membership?
Keep you healthy.
Keep me in shape, right? And to keep my mental health good, so I can drop those kids off in the giant play area and just sit and drink their gross coffee. But preventative care on that end. The idea is risk sharing is this PPO HMO environment, that they want you to be healthy. They want to do everything they can to get you healthy. And so the theory is then that if it's firing on all cylinders and you don't travel much, you have access to great care. Of course, the system falls apart when you're in a part of the country where there are no network doctors, right? That's when the whole thing falls apart. That's where you hear the horror stories. You go fly somewhere on business, you get a horrible car accident, everything's out of network, right? And that's just the reality of healthcare in the U.S. today, is that it is high quality, and if you're healthy, it's pretty cheap, right? And if you're unhealthy and everybody's in network, it goes well. But you can run into those issues with managed care plans. Okay. So it's the idea. Geographic region is kind of the one limiter there. And then they also, kind of that last bullet is they try to influence behavior, right? So this slide, HMO originally was bigger. You can tell we had some formatting issues when we moved it over. But the idea with an HMO is you kind of have a primary care physician. That physician ideally guides you through your care in all different aspects. Just like an HMO will offer a discount to a gym, they'll also offer free stop smoking programs for the same reason, that they'd rather insure non-smokers than smokers. They'll do free weight loss programs for the same reason. And so that, again, we influence behavior with incentives. Sometimes they're financial incentives. And we say, hey, free non-smoking clinic and free prescription drugs that go with non-smoking. And we really want to get you to quit smoking. And a lot of that is driven both by a true altruism care for you, but also a cost tendency. All right. So most common health maintenance organization, HMO. Your most common plan. The deal with HMOs is, generally speaking, you need to have. There's really 3 kinds. Most today are mixed model. That's kind of your more common, is a mixed model HMO. Closed panel HMOs, the physicians are actually employed by the plan. You don't see this too often anymore. Some Blue Cross, Blue Shield parts of the world actually have their own physicians employed there. And when you want care, you go to that building, that clinic. It's almost like a VA model, Veterans Affairs model, where the VA actually employs their own physicians and their own pharmacists and their own counselors. The closed panel HMO is a lot like the VA model, is that you go there for the care. IPA, or called open panel, is where the HMO contracts with member clinics and member doctors. That is much, much, much more common. That's all the ones I've been part of are effectively IPAs from that end, and not the yummy beer, the kind that pokes you and draws blood and those awful things. But the IPA, you've got these private clinics, and so you would have Christie Clinic, you'd have Carl clinics at Carl Hospital System, so that's kind of how that works in town. And then a mixed model where you would have some ability to go to the actual HMO provider, and then you could go an individual practice route, but individual practice route is most common. Right? The difference between a preferred provider organization and an HMO is you do not have a primary care physician. All right, that's the big deal here. A preferred provider organization, there is no central gatekeeper. Okay, so with an HMO, there's always a central gatekeeper. So if you like the central gatekeeper, if you have easy access to the central gatekeeper, an HMO works well. But a PPO gives you a little more flexibility because you don't have to go through the gatekeeper to get to the help, the doctors, the nurse practitioners, and the clinics. So a PPO gives you a little more flexibility. So what do you think is going to be more expensive most of the time, a PPO or an HMO? Usually a PPO. And in my experience, you're looking at around 20 to 25% more expensive, sometimes a little less. But a PPO is going to give you the access without going through your primary care physician. So again, cheaper, go through the funnel. More expensive, go directly to the clinic and physical therapy and doctors. And, you know, my personal opinion of it is that if you have a good, easy access, calls you back primary care physician office that is responsive and organized, then the HMO is a great fit. But if you're constantly calling, trying to get a call back, trying to get a referral, it's just a giant pain in the butt, and sometimes the PPO is just easier. Okay, so to that end, you know, that is kind of my 2 cents on that. All right, so your typical PPO, no gatekeeper. Right? That's your big takeaway there. And otherwise, it's very similar to an HMO, right? You have individual clinics, practices, physical therapy elements, and this end you've got Carl, you've got Christie, that are going to participate in all the local insurance plans. And so the PPO is the gatekeeper, all right? Again, if you use in-network, much lower copayments, possibly lower deductibles too. If you go out of network with a PPO, you're really not going to get much coverage. They're going to say, well, that's nice. You went to the Minute Clinic at CVS in Bloomington, and you're not going to get the $85 back. We're sorry, that's just not how we roll, but I hope you feel better. Okay? So that's your typical PPO. Again, in-network's very important there. Managed care, right? PPO is going to give you the same incentives as an HMO. Hey, go to the gym, we'll give you a little something. Quit smoking, we'll give you something. Here's a weight loss plan for free. Right? That's PPO and HMO managed care. No gatekeeper with a PPO, and it costs more. Right? Most PPOs are point of service plans. Okay, so point of service plans, you can pick where you elect treatment, and then you're going to kind of have in-network and out-of-network coverage. Usually that's going to be how a PPO works, and that's kind of the POS plan, and you can laugh at that if you'd like. Yeah, Presley can't help herself. It's good. All right. But the POS plan, the whole idea there is that you have the optionality and you choose where you go. You have a wider network sometimes with the POS plan. Is we say, all right, you've got your PPO, you've got your HMO, your PPO, and then your POS plan. The POS plan is going to have an extended network, additional physicians, maybe a member there, because it's going to be more of a reimbursement model and not necessarily a doctor-only sign-up model. So your POS plan is a bit of a hybrid. And in some large employers, you'll see those choices: HMO, PPO, POS. POS usually has the biggest network, and while it costs a little more, you do have access to more doctors. Okay. So just to kind of start those elements there, questions on managed care plans before we move on. It's most likely what you're going to get if you go to work for a big employer. You're going to roll in a managed care plan. Any questions on those? Okay. It's a Monday, isn't it? It's always Monday. I want to run this class on Wednesday once and see like how many good questions we get. All right. So we have options in health insurance of types of expense plans you can contribute to. We call them flex spending accounts. FSAs are often offered through employers. You can chunk a little money in an FSA and use that money to offset non-insured costs. So you can use it towards your deductible, you can use it towards your co-insurance, you can use it towards things that aren't covered. We also have HSAs, health savings accounts. And HSAs, as long as you have a high deductible plan, you can open on your own. These are options that employees have today. Can say, look, I know that I'm going to have a high deductible. I know I'm going to have some costs. So maybe I can look at some medical expense plans where I put money in the pot. And to that end, then I'm able to pay other costs, right? So we have FSAs and HSAs. You know the difference between those two things? An FSA and an HSA? Which one do you get to keep the money every year?
Simple.
HSA. Healthcare savings account, you get to keep the dollars. It's your account. With a flexible spending account, you're deferring part of your salary into an employer plan. And a flex spending account, you're actually not allowed to keep those dollars you don't spend. They revert back to the employer. So if you ever have the option, what are you going to pick? HSA, right? The FSA is a little dangerous because you might say, I'm going to put $1,000 a year in my FSA, and then you don't use it, and then your employer gets to keep it, and they use it for their Christmas party, and you didn't even go. It's so sad. All right. The other things too. Oh, go ahead.
Would you say like HSA would be a good way to go if that's one of your options?
HSA is a fantastic way to go for two reasons. One, you get a tax deduction on every dollar that goes in, right? And that's just awesome around the board. Two, there's nothing compelling you to spend it. You can invest in HSA in the market. You don't have to just put it in cash. So you could use an HSA knowing that the money will be there in your retirement and just not touch it until then. So HSAs are fantastic tools because it gives you like, here's your tax deduction, and then you can grow it, and then it comes out tax-free. It's the only thing that you get a tax deduction on the front end, tax-deferred growth, and it comes out tax-free. A Roth IRA, you use after-tax dollars. A traditional IRA, you have to pay tax when you pull it out, but an HSA is magical. It's like the unicorn of the savings world. So the HSA is awesome.
Do you have penalty for like taking it out too early?
If you use an HSA for non-medical expenses, you get hammered with tax on the growth and a 10% penalty. But as long as you use it for medical expenses, you're fine. So that's, yeah, you don't use an HSA for a boat. That's a horrible decision. But as long as it's medical expenses, it's tax deferred in, tax free out. There's nothing better than that. That's like the magic exploitive tool that's out there.
So if that's an option you would suggest?
Every day.
Okay.
I would pick it. I'd be like, give me my HSA. I don't trust you with my money. I don't want my money used for the Christmas party. All right, so HSA, not FSA. Okay, the other thing with all these health options, and Jocelyn, you can go kick one up there. All right, before we get to benefit carve-outs, all of these options, HMO, PPO, traditional plans, and some of these carve-outs, there's always an employer who has to kick in some of the premium. Okay, so, employee. So if you're self-employed, you pay the entire premium yourself. So imagine that your premium is somewhere around $1,200 to $1,500 a month for your family, and then you have a $10,000 deductible. How do you start to feel when you pay $1,000 a month, and then you have to incur another 10 grand of cost just to use the insurance, right? This is why we say health insurance is broken, because premiums are very high for a family if you don't have a federal subsidy. And with high premiums, and then you have to pay thousands of dollars just to use it, and then you have a copay when you use it, is this working? I don't know. You start to argue maybe it's not. When you could buy a Honda Accord for the cost that you pay into your health insurance, I'm not exaggerating that, you know, like, is this working anymore? And I think it's a fair question. So even with employer coverage, you've got to pay some of it yourself. Okay, so even employer coverage, some of it's got to come out of your paycheck. So consider that in your plan. But let's talk about things that are usually carved out. Usually health insurance will exclude these things. It'll exclude prescription drugs. That's a separate policy you have to buy. Usually you can bundle it with your health care, but it is a separate drug policy. Vision benefits are generally carved out. Dental is carved out with some exception for emergency surgeries. And then behavioral health can often be carved out, but not as bad as it used to be able to be carved out. And they used to be able to carve out maternity coverage too, but no longer. So those are benefit carve-outs where you can buy separate plans for these things. Vision, dental, and behavioral health, usually an EAP, Employee Assistance Program through work. You can buy one of those. So these are carve-outs, and you need separate insurance there. So on top of all that, we can have a probationary period for folks. So there's a period of time you can exclude an employee from coverage. If they don't work enough hours, you can exclude them from coverage as well. Generally, you can add your spouse for an additional cost. You can add your children or your spouse's children for an additional cost. There's some fantastic CFP exam questions about which health insurance. So you've got two parents, right? So you have two parents. So parent one is covered at work and lists the kiddo, and parent two is covered at work and lists the kiddo. So who's the kiddo's primary insurance? Okay. So the answer generally is the parent that they live with and they're dependent of. And if that can't be decided, there's a tiebreaker where you go with the birthday, calendar year birthday of the parent. If it's like a complete tiebreaker and both parents live in the home, you go with the tiebreaker there. But anyway, enough of that. Point being that you can add your child to your plan or your spouse's plan. If you add them to both, one is primary, one becomes secondary. Okay, so you have to list which is primary and which is secondary. We'll talk about HIPAA a little later. Domestic partner benefits are a thing of the past, but coordination of benefits is important. Who's the primary? And with dependent children, the tiebreaker, if you've got two parents in the same household that both live in the same home and the child lives there too, it's the parent with the earlier birth date happens to be the tiebreaker. It's kind of random, but you had to come up with something. All right? But if you live in different homes, you'll have different elements there. Okay. Other types of supplemental or carve-out coverage, we've been locked in. We'll never get to leave now. I hope someone brought snacks. If somebody has snacks. Gwen, you got snacks? I get Gwen snacks. No one else gets snacks. There's Medicare carve-out plans. If you have employees that are over 65, you can do a Medicare carve-out. So you can actually offer them insurance that doesn't cover anything Medicare covers. So it's like you're just giving them the extras that Medicare doesn't cover, so you can save some money as an employer there. You can offer Medicare supplement insurance, and this is usually done for larger employers. Like Microsoft is going to say, okay, all my employees that are over 65, instead of giving you health coverage, I'll give you Medicare supplement insurance. So as long as you work there, you get a little extra days in the hospital and any extras the Medicare Part A and B doesn't cover. With claims, managed care plans do their own paperwork. That's why you want one, right? An HMO or a PPO handles all the paperwork, so you don't have to file forms, you don't have to file claims as often. With an older school indemnity pay-you-back contract, you actually have to file all the forms, provide receipts, ship them off, and then have them come back. So that's actually horrible and awful. Most of the time, the provider gets the check. You're not the middle person for the check, right? They're going to write a check directly to the MRI or the physical therapy. You're not going to get it and then have to turn it around. So property casualty, quite often you get the check and then you have to give it or write it over to a contractor. So if you have the roof blow off your house, you get a giant check in the mail, but it's not yours, right? You need to then sign it and then move it over to the person doing the work. With medical, there's no middle person. It just goes straight to the provider. All right. Dental insurance. Dental insurance is a carve-out. We talked about that earlier. So most healthcare coverage doesn't cover dental. So you buy dental separate. Dental insurance has limits. You want to write that down. Generally, there are limits. There are limits to avoid adverse selection. So if I put limits on the plan, it's going to avoid people taking advantage of the plan. And that keeps dental insurance cheap. Dental insurance somewhere between $25 and $50 a month. So we're looking at for dental. So with dental insurance, we usually put annual limits on it per procedure. So we usually say, like, we'll do root canals up to $1,000. We'll do crowns up to $1,000. It's usually flat dollar amounts. Preventative care, you can usually go twice a year and get your teeth cleaned. And again, what's the theory of that? Why do I want to pay for preventative care? So you don't have the root canals, right? So preventative care keeps your mouth clean. And just a side note, because I am married to someone that has her dental hygienist license, heart disease starts with gum disease. So keep that in mind. The little nasty bacteria make their way to your bloodstream and kill you. So make sure you take care of your teeth through your life. All right, so go to the dentist, get your teeth cleaned. It's 45 minutes of awful, and then you live longer. All right, taxation of health insurance. Employers, this is a pain. C corporation employers can deduct 100% of medical insurance premiums. Pass-through LLC and S Corp are limited. If you are more than a 2% partner, that ability to deduct is limited. So if you own your own business one day, one of the reasons to incorporate that business is to start deducting 100% of your medical insurance costs. That is a legitimate reason you sometimes see a company go from being a sole proprietorship to a C Corp, is that that's a pretty big deduction. And the more employees you get, the more you're going to want to take that for yourself and your employees. So your ability to take that deduction if you're a sole prop or an LLC or an S Corp is one of the reasons people go straight to C Corp when they incorporate. All right, so C Corporation, that's where we can take 100%. Employees, the deal is that the benefits aren't usually taxable. What you pay towards your health insurance is usually deductible. So if you put $200 a month towards, it's usually tax deductible, comes out of your check. If you were, in some weird world, paid more than the cost of the procedure, that's taxable income. I don't think that's ever happened in the history of American health insurance, but if it ever did, that would be taxable income. You need to report that. So a flexible spending account is technically a salary reduction. That's why it's not that great a thing. FSA, or flexible spending account, an employer reduces your salary, and that goes into an employer bucket. And the employer manages the bucket, and you take money out of your FSA. But anything left in the bucket goes back to the employer. So you got to be careful with that. All right. Self-employed premiums are deductible, but it's so much harder today than ever before. So with the new Tax Reform Act, what we did was we raised standard deductions for most Americans. Right? We popped those up. So there are fewer Americans that are going to take itemized deductions. So your ability to deduct your health insurance was only to the extent it exceeded 10% of your AGI, and now it's got to exceed it by even more than the new standard deduction. And effectively that means self-employed people can't deduct their health insurance premiums anymore. It's kind of crappy. So what happens when you leave an employer? Well, it's not such a big deal anymore that pre-existing conditions are covered. This used to be a real heartbreaker. In fact, this is why people stuck around at jobs that were kind of junky sometimes. Before we eliminated pre-existing conditions, if you lost your employer coverage, it could be catastrophic because you would have pre-existing conditions hit you in the private market. So if you had cancer and you left your employer because you were sick, that was horrible because then no insurance company would take you. Right? And that was the world before the Healthcare Reform Act. That was very, very hard for Americans. So what we created is this idea called HIPAA. And HIPAA is about healthcare privacy, but HIPAA also allows employers to keep employees that leave an employer to keep their coverage for 18, 24, or 36 months after they leave the employer. And the whole idea there is to give you more time to find another job, to give you time to find other coverage. So there's HIPAA situations where if the employee terminates coverage, if they quit their job or if they're fired, they have 18 months where they can still participate in employer coverage through a HIPAA program called COBRA. So you have to pay 102% of the employer previous premium, but you can still participate in the plan. All right. So if the employer, the employee quits or is fired, you have 18 months that you can still participate in your old employer plan. You have to pay 102% of the premium, but that employer can't drop you from the plan. All right. So that's 18 months of coverage. If you go from full-time to part-time, it's going to be another 18 months of coverage issue where you can still get a year and a half of coverage. If you're disabled, you get 24 months, and if your spouse dies, you get 36 months of coverage on the spouse's plan. If your kid ages out of the Healthcare Reform Act, do you know that age limit where you're not covered by your parents' plans anymore?
26.
26. You get an extra 3 years of coverage on your employer plan through COBRA. Again, 36 months. So continuum of employer coverage is through COBRA under HIPAA, and what it does is it allows you to still have coverage of an employer plan. Now, this isn't as important as it used to be. Now that we waive pre-existing conditions, you might be able to go into the healthcare market and find coverage that's better, find coverage that's just as expensive, but this is an option that's there from the days before we waive pre-existing conditions. That's why these protections are here. In a perfect world, you wouldn't need them, but that's why they're here. That's why you have COBRA. COBRA is here because there used to be a world where you lose your employer coverage and find yourself uninsurable, right? So that's why we have COBRA protections, right? So 18, 29, 36 months. Sorry, I misspoke about disability. Disability is 29 months. So 18 months are generally what we call employer-oriented events. So you quit your job, or you're terminated, or you go from full to part-time. In that case, you can get 18 months of coverage. 29 months is for being disabled, and 36 months is if your spouse, you're under your spouse's plan and they drop dead, or you age out of the plan. Here's the catch, though. The premium can be 102% of the total cost to the employer. And if the employer is paying $800 a month of your cost and you're paying $200, how much do you think you pay if you go into COBRA? Right? So the employer's paying $800 a month for your cost. You have to cover $200 of that. Okay? You quit your job or you're fired. You have to pay 102% on the whole $1,000. Right? So COBRA looks ridiculously expensive because the employer's not pitching in to help you anymore. That's why COBRA is so staggering and shocking. You get a letter in the mail after you leave a job, and it's like, would you like to continue on the healthcare plan? It's going to cost you $72 billion a year. And the reason for that is the employer match is gone. So now you have to pay 102% of the entire cost of the plan. One last note that applies to people in this room. COBRA only applies to employers with 20 or more employees. And there are some of you that are going to go to mom and pop RAAs that maybe have 3 or 4 people working there. They do not have to extend coverage to you after you're gone. So for those of you that go to work in small arrangements, and I know a lot of you will, that arrangement does not have to put you on COBRA. So in those situations, you may find yourself, if it doesn't work out, without insurance the next month. All right, so you got to be quick on your feet if that happens to you, and jump into the private market very quickly, because there's no guarantee you'll have COBRA. Now, this is different than sometimes when folks are laid off, their employer gives them X months, bless you, of coverage. All right, that is different than COBRA. COBRA starts after those months are expired. All right. So questions on COBRA and getting fired. Fun conversations today. All right. So 102%, you need to know that. And if you work for a mom and pop RAA, they might not have to offer it to you. Okay, so that's something to be aware of if you go to work for a small company. Qualified beneficiaries then are kiddos And usually the umbrella is employee, employee's child, spouse, spouse's child. So if you marry somebody who already has a kid, that kid becomes covered. That's the umbrella there. Right? Already got through the rest of that. Okay. Additionally, retirees can opt into Medicare. Usually an employer has some kind of Medicare Advantage plan or extra plan they can buy into there. All right, so those are continuation of coverage. An employer usually has some compassion and offers other benefits to employees that become terminally ill. You know, you work at a large major employer and you get really sick. Quite often they'll leave you on the health plan, you know, as long as they need to. It's not like everyone in the world is a jerk face. Just be aware that compassion, you know, bottom line, sometimes don't agree with each other. So keep that in mind when you take a job. Read about the healthcare coverage and the insurance options. All right. Some plans, HMOs and PPOs in particular, as opposed to traditional health insurance plans, will let you convert, and most PPOs will. So if you are in a PPO and you lose your job or you decide to quit working there, most PPOs will give you the option of just signing up by yourself. And they'll say, hey, just stay in our network. We like you. And that's called a conversion privilege. So some PPOs or HMOs go ahead and offer you an individual policy and say, why don't you come on board and be with us? All right. Group to Individual Portability Act. So a HIPAA letter used to say that you know, this person is allowed into the individual market within a period of time if they can find coverage. Again, with the Healthcare Reform Act, this is a little less relevant because losing employer provided coverage is not as catastrophic as it used to be. But by law, we still have this happen, that if we leave employer coverage, we can roll into an individual plan if we can find one that'll take us. And usually that will help waive any pre-existing conditions. Of course, that's gone now. But if it ever comes back, we'll go back to this model. So the reason I left this slide in is to talk about, you know, you're going to come into a world where pre-existing conditions aren't a thing. That doesn't mean it'll always be that way. And one of the big health reform health reform arguments is, okay, well, if everyone in America is buying a Honda Accord every year with their health insurance costs, some people might want a cheaper system. So maybe some people opt into a system with pre-existing conditions or lifetime benefits or things like that. So just be aware that this was a thing and it could be a thing again. All right, let's talk about plans that I can go buy today. All right, so if I decide to go to work for myself and I don't have group coverage, there's two choices. I can buy a managed care plan just like a big employer can, or I can buy individual major medical. Individual major medical plan we haven't really talked about yet. It's a traditional reimbursement plan where you kind of pick what you want, what features and what levels. It's not managed care. Instead, it focuses on reimbursing costs. So managed care focuses on keeping you healthy. Indemnity plans focus on reimbursing costs, right? So those are two types of plans. Blue Cross Blue Shield tends to be major medical. So Blue Cross Blue Shield, those plans tend to say, how much will I pay back? What percentages will I reimburse? That's the focus there. Your Aetnas, your Cignas tend to be more of the PPO HMO models. Right? So when you shop coverage, those are going to be things. And when you look at the Federal Health Care Act, you can opt into different plans. Again, managed care for younger people tends to be cheaper. And my advice, if you find yourself either unemployed or self-employed, managed care for younger Americans that are healthy tends to be the way to go. All right. We talked about Medicare yesterday or last week. Was it last week? A lot has happened in that week. A lot has happened. I've spent a lot of money on a dog. A lot of money on one dog who's fine now, by the way. Mr. Truman's fine. We can all rest assured. He had a fever over the weekend, and he wasn't moving, and he was shaking. When he breathed, it sounded funny. So we were like, this is bad. What is he eating? We took him to the vet, and they did blood work and x-rays, and then they sent the x-rays to a radiologist, and then they took the 529 plan. They were like, we'll just take the 529 plan, thank you. And they were like, oh, he's got an infection and he's got a fever and here's some drugs. And then 2 days later, he takes food from the baby, bites her hand a little bit, and sits by her and wags his tail while she cries. So we're back to normal. Mr. Truman's fine. Oh, I don't know. Do you say thank God for that? Because it's like, I'm happy that he's here. I love him. But it was a very expensive weekend for Mr. Truman. And that's all I remember. It's a screaming baby, a happy Mr. Truman, and I'm a lot poorer than I was on Friday. But back to this class. So it's been a long time since last week to me. Medicare supplement, Medigap insurance then. Again, we talked about Medicare Part A, B, D, and F. This is Medicare F. I'm going to write a little note. It's Medicare Part F. These plans give you the extra goodies, more hospital costs, more blood. Yeah? Everybody like that? More pints of blood? Yeah, it's 3 more pints of blood than the other plan gave you. And so it picks up things that Medicare doesn't. Your deductibles, your co-pays, etc. That's Medicare Part F. Medicare Select, you can take A, B, or Select. Medicare Select is a managed care plan. Some regions offer it, some don't. But it's going to say, hey, buy our policy. Instead of Part A and B, we'll be your provider. And so you can go to Carl, and you can go to, what's the other one? Carl and Christy, and we'll take care of you. What?
Persons.
Oh, they changed their name, right?
Well, Christie's the clinic and Presence is the hospital.
Oh, okay. I didn't know that. Well, we had Ellie Jane at Presence. Anyway, so Medicare Select policies say pick our services instead of federal Medicare, right? And if you don't travel much, this is a good idea. If you travel, this is an awful train wreck. Okay, so if you travel, don't do this. If you don't travel, it works. All right, we talked about dental. Temporary medical insurance, I just want you to write the word risky next to that. It's coming back. Temporary medical insurance is cancelable. Now, different types of coverage, if you remember back to week 1 when we were all together, we talked about types of coverage. And cancelable is the type of coverage where the insurance company can cancel you at any time. It's the most favorable to an insurance company of any type of coverage. So temporary medical insurance is very risky, and after you file claims that are big enough, it usually gets canceled. So keep that in mind. It's coming back. It's more popular today. People are using it as sort of catastrophic health coverage. Travel medical insurance, this is going to be for all the future financial planners. All right, tune in for just one moment. International travel medical insurance is one of those recommendations you can make to the clients of the firm you work at, and you will be a hero the first time somebody slips and falls on a cruise. All right, travel medical insurance, you pay by the trip where you're going. For somebody like my dad, this is worth its weight in gold. They usually have medical evacuation. They promise to pay all costs while you're overseas. And when you get on a cruise ship from a non-US port, your Medicare does not cover that. So if you fly to Europe and get on the wine cruise, which Bill did this year, if Bill slipped and fell on the wine cruise, which, by the way, it's a wine cruise, the chance of this slipping is really high. You're there for one reason. It's drinking in Europe. That's why you went, right? Drinking in Europe with the olds. That's why you go on a wine cruise. But international travel insurance takes care of every cost. They say, we're going to evac you out. We'll fly you back to the U.S. We'll take care of your hospital costs. The premiums are done by the trip, by the length of time you're gone. If you come into a firm and one of the firm's clients is traveling and you make this recommendation, I mean, it's a no-brainer when you're working in affluent markets. You're dealing with people that can clearly pay. A lot of the people in that market, the $2 to $5 million market, can pay for this. Whenever they travel, they just don't even know it's there. It makes life so much easier if something bad happens. So if that's where you go to work, keep that in mind. All right, international travel insurance worth its weight in gold, and you'll come out looking like a champ. Surgical policies used to be a thing. Now with managed care, they're really not. It would just be we'll pay for certain things. Disease policies, Aflac. You've seen Aflac commercials? So Aflac is like a dread disease policy is what it's called. Aflac is going to be if you get certain types of cancers, Aflac pays in addition to your healthcare coverage, right? If you have certain injuries, Aflac pays in addition to your healthcare coverage. So Aflac is a critical illness insurance, a specified disease insurance. It doesn't pay your everyday costs, but if you have certain events, it gives you extra. So Aflac's, again, in the blue collar market, absolutely critical. If you work with your hands all day, you really need that. State high risk pools, you know, you're dealing with state pooled coverage with, again, with a lack of pre-existing conditions. That's not really a thing like it used to be. Right? So, you know, again, the Health Care Act changed the pre-existing conditions. I think I've kicked that into the ground a little bit. So key provisions, this is the deal, all right? And we can spend just a little bit of time on that because we only have 7 slides left and we have, you know, technically 2.5 hours of class I can drag you through. You know, the Affordable Care Act, the Patient Protection Affordable Care Act, you know, here's the thing. It did 2 things, and one, it did very well. One, it did expand access to all citizens. Yes, you can't argue that. Right? The Affordable Care Act made healthcare available for all citizens. What it failed at is keeping it affordable. The idea behind it was this, that the room full of you guys, right, as healthy Americans as we have right here, would be forced to get health insurance, and in exchange, it would help cover the cost for someone like my dad, who's 81, right, and older and has more costs. So the idea is that you'd all be paying premiums and you probably wouldn't use it. Bill would pay a premium and Bill's going to use it, and then it works. What has happened, though, is that the cost of care has gotten so high for any number of reasons. Pharmaceutical costs, hospital costs, like just student loan debt for physicians. Like it's just a huge network of more expensive healthcare today. And so even with you guys paying in, it's still obscene. Right? So the costs have gone up since the Act passed. That's one of the big things that's happened here. The second thing is that do we have improved quality of care? And when you look at mortality rates for mothers in the United States, we're somewhere worldwide at 30. Like a lot of women still die in childbirth in the US. That shouldn't be the case, right? We should have better care. And so you can say that the Health Care Act, yeah, it hit bullet 1. Sure, right? I'm not sure it did 2 and 3, right? So we say healthcare is broken. I think both political parties will tell you it's broken. I think it's broken. And so that, to me, is really the big takeaway is, like, how do you fix it? And y'all are going to be the ones that vote the people in to fix it, right? Because I'm just going to quit voting and live on an island and eat my own fish and shoot airplanes that fly over. That's my goal, right? Libertarian Craig. But the reality is that y'all are going to have to kind of come up with solutions to this. Is like, it's just not working like it is. It's too expensive for a new doctor to become a doctor. You start there, right? You're going to spend $300,000 to become a physician. You know, by the time you pay that off, you're 40, like maybe 45. So you got to figure out, like, how do you make this stuff cheaper? And I'm not sure there's really good ideas to that. Right? And Mark makes a fantastic point. The original Healthcare Reform Act had a big stick, and the stick was, if you don't buy health insurance, if you don't pay into the bill, my dad's system, right, you got penalized, and you had to pay a federal income tax penalty. That's gone now. So the current administration got rid of the penalty. So now there's nothing other than common sense that forces you to buy health care. So if you don't want to buy health care and you're healthy and you're going to roll the dice that you're going to be fine in a year, then you just opt out. And then it just makes the system more broken as we go. So Mark, thanks for that comment, right? Like this is the problem. It's broken and now it's more broken because we took out the stick that we were using to force Colin to buy health insurance, right? That's not there anymore. You don't have to. And as of last year, you did. You got hit with the tax penalty. Now that's gone. So it's really something that has to be addressed by both political parties, because otherwise it's just going to be more of a train wreck. How do you fix it then? All right, there are 13 essential health benefits on any policy issued today. One of the considerations is, what if we have policies that have some optionality in the 13 essential benefits? All right, so that includes maternity care, it includes certain type of blood work, cancer care. There's other elements to it. I do not have them memorized. But the essential health benefits, there's 13 of them. And this is all right, any policy today, you get these 13 things. And in the past, that wasn't always the case. So do we cut that back? Right? There's one option, right? So maybe instead of 13, we cover some other things. Secondly, if you don't find a job that offers health insurance, you can stay on your parents' plan until 26. That's an option at 29 by the time you figure COBRA. So is that good or is that bad? I don't know. And also preventative care and medical screenings. You get one wellness visit a year for free, right? So women get one women's wellness visit a year for free without cost sharing. So maybe we adopt that model. And you know, there was an individual mandate. There's not anymore. Okay, so that individual mandate used to say anyone living here had to buy coverage. Now we've gotten rid of it, right? So now you don't have to. All these are ideas in changing it. One of the other big ideas is Medicare for everyone. Well, there's an idea, right? So everyone gets on Medicare. But Medicare, you know, contracts on what it pays out. So then you kind of like cripple the talent pool going into medicine. Because if medicine doesn't pay well, then the best minds aren't going to go there. Okay. Oh, we've lost it. We've lost it.
Yeah, Glenn keeps burping.
This is awesome. I love this
Keep me
class.
in class with them, Greg.
I know.
This is why she doesn't come.
All right. Well, it does make it less sad. So what else we have then is one of the ideas of fixing healthcare is this. If you cut the payments to physicians over time, that cuts the best minds and talent that want to be doctors, right? So do you want that? Right? That's a fair conflict. It's like sometimes people go into medicine, you know, altruism aside, it's a very well-paying job. But if you cut that part of it out, then do you have the same quality of medical providers, right? So that's another question you run into. I think your real solution to this is multi-factor. I think you have to really consider that there needs to be some cost management, there needs to be some drug management, some hospital management, and maybe some of that's federally employed. But I do think you've got to figure out a way to balance all these stakeholders. All right, health savings accounts, big star on the page. If you can do one, buy one, get one. I have one. HSA Bank is a good one. That's where I go. Oh, and that's going to be forever. As long as we offer this class, that sneeze is going to be there. Like Gwen's burp and Craig's sneeze. And Truman's alive and eats the baby's food. So healthcare savings accounts are the best thing going. They are absolutely amazing. You get a tax deduction and then you get to use it tax-free and it grows in the market. There's nothing like that. You can find HSAs that you can invest in stock portfolios. You can invest in fund portfolios. And I can't stress enough that if you have the capital to do this, it's a fantastic way to have some money set aside in an emergency fund for healthcare costs. And also, as you get older, these dollars become more vital and they can supplement Medicare down the road. You can start pulling them out when you're older. You know, I think this is a fantastic, fantastic plan. And we've already talked about it a little bit, but the amount indexes every year. So you have to be in a high deductible plan. And then if you're individual or if you're married, there's different thresholds that you can contribute. But I can't stress enough how powerful these are in financial planning. I encourage your clients to do it. If you go to work for a firm, again, you come in like a superstar if they're not using HSAs and say, look, international travel insurance when our clients go overseas and HSAs. And right off the bat, you've added value to that firm. All right. You know, what can we discriminate on? With health insurance, age and gender, yeah. In other words, I can charge you different amounts for different ages and different genders. Smoker, non-smoker, I can discriminate on that factor. We can't discriminate on occupation and health insurance. We can in disability. We can in long-term care. All right, so those are issues where we can discriminate on costs. What you find is a whole bunch of geographical discrimination. Atlanta is the best possible market to this. Atlanta proper is in one county, and I don't remember what county Atlanta is in. There's multiple health insurance providers competing in Atlanta. And if you drive 25 minutes northwest to Duluth, you have one health insurance provider in that county. And your premiums are almost double if you live in Duluth versus if you live in Atlanta, because there's no competition to drive them down. All right, so geographical discrimination is a really big deal in health insurance plans. And where you live, you dumb luck into having 3 people competing for you in the federal marketplace if you don't have group coverage, or you might dumb luck into being rural with one provider, and they're going to charge you an insane amount. So where you live is very discriminatory with healthcare costs, whereas your actual health isn't. That's kind of weird to think about, isn't it? Like where I live versus my Twinkie consumption, and one of those is fair game and one's not. But that's how it works today. So geographically, that can be a retirement decision. I want to retire somewhere where there's multiple providers, where I know then that if I buy a Medicare supplement plan, or if I retire before 65, how can I make sure that what I'm paying isn't outrageous? And let's retire somewhere with multiple companies competing, as opposed to retiring out in the sticks and you're just going to take it on the chin. Okay. Generally speaking, you've got a grace period and medical expense policy of 31 days, same in long-term care, same in life insurance. The grace period says you've got this long to make your premiums whole until we cancel the policy. So the grace period in life insurance is somewhat self-funding, in that if you die during the grace period, you get your life insurance back less 1 month of premium that pays the grace period. But in medical expense and long-term care policies, you're going to have to make that premium up before you can use the coverage. They just won't drop you. All right, so that's that 31-day grace period. There you go. All right, so that's it for health insurance. Very important stuff for your careers. Again, CFP exam, this is fair game. Usually you see not many questions out of health insurance, many more out of life, but health maybe get 1, maybe 2. It's not tested that heavily, but it is fair game. So any questions on health insurance? Sure.
Can you buy insurance out of your HSA contribution?
Yes, you can use that for premiums. That's a fair cost. Yeah, you should be able to deduct premium costs.
How do you balance that with the retirement accounts?
Well, I think as a young person, an HSA would be very important, especially like for y'all. Making a generalization, but generally speaking, you're not going to run out and have a kid right away. So that money being there, if that one day happens and you have kids, is going to be really important in paying for those extra costs. So I think it's worth starting out. You know, the general financial planning advice you give a young person is to spend less than you earn, right? So avoid the credit card debt. Like right off the bat, spend less than you earn, make it a hard rule. Always take your employer match at a minimum in a retirement plan, absolutely minimum. Then a Roth IRA and an HSA would be next. I would do that, and I think I take the HSA first, just from the standpoint that there's fewer limitations on taking money out of that than a Roth. You can always get your basis back out of a Roth, right? It's like a nice emergency fund kind of thing. But an HSA gives you the addition of having a tax deduction on top of everything else. So good question. That's how I'd answer it. I'd always take the retirement plan with the employer match, number 1. After that, maybe you look at an HSA and a Roth, maybe you do 50-50 on that. Here's my general advice for everyone in the room. Poor Jack. Other questions? All right, so have a happy fall break. When you come back, you'll have a nice project. I appreciate everyone for coming tonight and listening online. This was a lot of fun. I hope you enjoyed it, and we'll see everybody next time. Have a good one.